I'd like to introduce the moderator, Mr. Scott Alderton. Ask the other members of the panel to join us. Scott is the founder and partner of Stubbs, Alderton, Marklees, and LLP. He is the co-chair of the Venture Capital and Emerging Growth Practice Group. He is a technology lawyer and frequent speaker on the subjects of technology, intellectual property, capital formation, and capital raising transactions. And he represents technology and emerging growth companies in many of their activities. So I'd like you to join me in welcoming the panel and our moderator, Scott Alderton. Scott, nice to meet you.
Thank you very much. It's good to be here. I think that a couple of my panelists are not quite here yet, but they called me and said that they're at various places trying to get up here and parked and everything, so they will join us shortly. I know that one was just right out in the lobby, and there he is, Mr. Collins. So we'll have Bill come join us, and I'll have these three introduce themselves. So we're really fortunate to have the 5 panelist members we have. If there are a dozen or so people in the Los Angeles venture community who are critical to get to if you're financing a new venture, we've got 5 of them in the room today, which is really great. And I'm going to just let them introduce themselves and tell you just a little bit about their fund briefly and where they sit in the ecosystem. And we'll just start down at the far end with Kevin Jacques, who is a partner at Palomar Ventures. Go ahead, Kevin.
Palomar is roughly a 10-year-old early and mid-stage venture capital firm. We have about $500 million in total under management. We tend to look at the classic Series A, Series B deals, companies raising, call it $4 to $6 million, $4 to $8 million in an institutional round.
Rick?
So Rick Smith, glad to be here. I'm a founder at Crosscut Ventures, which is an early stage seed fund based here in LA. We are looking to invest in young companies, raising rounds of $500,000 to $2 million. We've invested in several startup companies around Los Angeles, including DocStock, which was founded by a Pepperdine alum, Shoe Dazzle, and several others in and around LA. E-commerce, mobile gaming, places, online ad technology, places that we look and like. I've been doing in private equity for 23 years now. Used to do leveraged buyouts and switched over to venture capital about 13 years ago as part of apparently a tax avoidance strategy. It's been a tough 10 years in venture capital.
And this is Bill Collins, who's representing the Tech Coast Angels today and various angel groups. Bill.
Yeah, and I don't see my name here, so I'm happy to masquerade as Scott Alderton if you don't like what I have to say. But the Tech Coast Angels is actually the largest angel investing network in the country. It's focused, though, just exclusively on Southern California, and has been in existence for about 10 years. We have networks across Westlake, Santa Barbara, LA, Orange County, San Diego, Inland Empire, and about 300 investing angel members, and typically do about 5 to 10 million a year of our money into new companies, and get about 100 million into the portfolio from other venture capital firms on an annual basis. And TCA is continuing to be quite active, and I think we'll talk about that during the session. My background, I was had an engineering degree, was early with Intel, one of the early lead salespeople on the IBM account. That had its own entrepreneurial side, even though it became a very big company. I also was running businesses, et cetera, up until about 2000, where I became a full-time angel investor and mentor of technology companies.
And just joining us is Dana Settle, who is a partner at Graycroft Partners.
But apparently geographically
no,
challenged.
The directions were challenging.
So my name's Dana Settle, partner with Graycroft Partners. We are an early stage venture fund. I've been working in the venture business. Are we doing firm and personal?
Yeah.
Okay. So So I've been working in the venture business for about 12 years now. I started up in the Bay Area at Mayfield, which is one of the older venture funds on Sand Hill Road. Spent 6 years there as an associate and then venture partner. And prior to that, actually started my career at McCaw Cellular Communications when it was an entrepreneurial company prior to being sold to AT&T in international business development. So moved to Los Angeles about 6 years ago. I left Mayfield and actually headed up business development for a startup called Truvio, which was a video search company. Sold the company to AOL about a year after it launched, which is a nice outcome. And you know, sort of one of those like perfect startup scenarios. And then helped, when I moved to Los Angeles, helped start Graycroft, which I co-founded with a much better known man by the name of Alan Patrikoff, who's the founder of a large private equity firm called Apex Partners. And he's based in New York. And we really started Graycroft with the idea of kind of breaking some of the rules around venture capital in terms of not necessarily having sort of set percentage ownerships that you had to achieve, or you know, specific amounts of dollars, specific amounts of capital that you had to put to work, but rather really doing what made sense for the company. So we'll talk more about that throughout the course of the discussion. But we started in 2006, raised our first fund, $75 million fund, and then last year raised our second fund, which is a $130 million fund, and continue to invest in early stage companies in the digital media, consumer internet area.
And we will be joined shortly, because I spoke to him on the phone, I'm sure, by Greg Martin. So I will just tell you, Greg Martin is also a very well-known venture capitalist in the Los Angeles community. He spent several years as a partner here at Redpoint Ventures, which is a Silicon Valley and Los Angeles-based venture capital firm that focuses on the early to mid-stage venture market. Greg left Redpoint Ventures last year, or early this year, I'm sorry, to form his own firm called Archer Venture Partners, which is focusing on very early stage and seed investments. And this is Greg right here, so glad you can make it, Greg. Just perfect timing, and here we are. So I have a whole list of questions that would take us more than 2 hours to get through, so I'm going to just kind of bounce around quite a bit, and I'm going to sort of stay focused on earlier stage issues because I think that that's what this audience is probably most interested in, and I'll leave some time at the end of the day, at the end of the session for some questions, and then I would encourage you to come up and make sure you get these guys cards because they really are an all-star panel for this space. So I think one of the things, guys, that you hear, that I hear when I come to places like Pepperdine Center or other events around town where there's early stage entrepreneurs is everybody seems to think that there's this big VC or money shortage in Southern California, so I want to debunk that myth. So let's just sort of, maybe we'll start with you, Rick, in the middle. And you know, is there a money shortage? Is there money out there for people who are coming up with new ideas and trying to monetize their technologies?
Yeah, so yeah, there is. I think there's the landscape's just changed a lot the last 2 or 3 years in Los Angeles. I think I don't think there's ever been. I know there's never been as many companies being started in LA as we have today. It really has taken off the last 3 or 4 years. A lot of now serial entrepreneurs coming out, folks who have been there and done it once or twice before. Are coming back and maybe doing, you know, they weren't the CEO of the last one, they are doing the next one. MySpace has spawned 5 or 6 companies alone, right? Maybe even more than that. So the entrepreneurial activity is high. The capital is there. It's a little harder to find, I think, and probably need to, in the earlier stages of companies, probably need to find, you know, friends and family, seed investors like us and TCA, Tech Coast Angels. There is money there for sure, but these are tougher times, and we're losing some venture capital firms here in Southern California. Northern California is losing a lot of venture capital firms. The industry is definitely shrinking, but the amount of capital it takes to start a company, at least a lot of the companies that we're looking at, it has gone way down. So, you know, the ability to get up, get going, hit milestones, and raise money, I think, is it's not a bad time for that, and it's easier to hire people right now. There's a lot of reasons why it's not a bad time to be starting a company.
Okay. Bill, I'm going to get to you in the angel position in just a second, but let me jump over to Kevin and just say, Kevin, I know that you guys have actually been pretty active, so why don't you sort of address the same question?
I very much agree with what Rick said. I think there is perhaps a shortage of institutional capital in the market, but there's certainly an abundance of great ideas and strong, experienced entrepreneurs, here in Los Angeles. If you contrast this region, say, to Boston or the Bay Area, in those markets, there's a much higher percentage of institutional capital that comes from in-market that invests in startups in-market. In the Bay Area, it's around 50%. Here in Southern California, it's around 10%. And for companies that do need more money, that are either the successful companies that Rick invests in at early stage, or they're an enterprise-facing company that has to raise $20 or $30 million to go the distance, it does pose some interesting challenges here. If you're in the Bay Area, you can hang out at a Starbucks near Sand Hill Road, the one at Sharon Park, and you'll see 15 venture capitalists per hour coming through to get, their coffees. It's harder here. The geography is spread out. There are fewer firms. You really have to do your homework to find, the people who are the right fit investors for what you want to do.
So, Greg, you left Redpoint and you've started Archer, and Archer is sort of focused on this wealth of entrepreneurial opportunity in Los Angeles. So what was your thinking when you did that?
Well, I was going to say that most of the capital in Southern California is nicely represented on this panel, which is good. But we definitely need more, more firms down here to grow business, particularly the ones that are that require greater amounts of capital before they start generating meaningful revenues and cash flows. You just don't see those kinds of companies being funded down here. But as Rick was mentioning earlier, the need for bigger early round financings that typically the bigger firms like the firm that I left, Redpoint Ventures, would fund is a lot less in this environment. I mean, you can get companies started, sort of renting servers and storage and CPU space on Amazon. You can very effectively market your businesses using the web. So you can get, particularly the whether it's a business internet business or a consumer internet businesses, you can get companies going for relatively little. And so all of a sudden those, friends and family dollars, those angel dollars, those, seed fund dollars that I think Rick and I are probably more focused on, really can go a long way. And so I think that's going to be, it certainly is the new model in terms of how entrepreneurs get their businesses going, but I think it's going to be, the new investment model too, which is, really, and you're going to see it from big firms too, really getting in and getting involved in companies at an earlier stage because they're not going to need as much capital going forward.
Mm-hmm. So Bill, why don't you tell us, I think people often think of the Tech Coast Angels or some of the other organized angel groups around town as, I have an idea, I'll go talk to the Tech Coast Angels and get some money and start this up, but that's not really exactly how the process works.
Yeah, I think from a process standpoint, it's interesting. You could say that everything has kind of slid to the left in terms of who funds it. If you look at what banks used to do, they're a lot more reticent, as we all know. So then you've got private equity firms. Well, private equity firms now are, in some cases, having bank-level due diligence to do a deal, and so that falls to later-stage venture capital or doing what private equity firms might have done, what late-stage might have done. Now early-stage venture firms are doing for criteria. What early-stage had done, now angels are doing for criteria, and what angels would do are being done by friends and family and true believers. So kind of as Rick said, you'll see a smaller amount of money looking to come from friends and family and true believers first. And the angels now are actually doing, Tech Coast Angels is having a big kind of normal year in that so far there's been 8 new investments and 14 follow-on investments, so 22 investments made by TCA year to date. There'll be 2 or 3 more before it's over. The average dollar per investment has come down, much like the infrastructure, so it's about $500,000 a deal. But TCA is very active. Now those companies have a further along profile than a seed at this point. And if we have time or if we want to discuss it, we can talk about that profile. But things have changed that way. I would also say that there is certainly less institutional venture capital available than there was. Because of that, we as angels look much more carefully at the burn rate and how much money and how far that money will go, because we need to get it far enough that next stage venture capital is an opportunity but not a dire need, or else we could find ourselves in trouble, in a gap.
Okay, why don't you just also follow on with that, Bill, and tell us what is that profile, and from the Angels' perspective, and then we'll move to Dana, who's one step right of you on that spectrum, and say, what does a fund look at?
Okay. Yeah, so a minimum profile, if you look at it, is there's two inventions that have to be made. You have to substantially invent your product, but you also have to substantially invent your customer. And we're looking for both, in that kind of the minimum criteria is that your solution is far enough complete, so there's no more invention required. This is workmanlike engineering or activities to truly bring it to market so that it's more predictable in terms of time and money. The second thing is you have to be engaged with customers. They may not be buying yet, but they have to know you. They have to have validated your value proposition, and we have to be able to give them a phone call, and they say, yes, we know this company, we know these people, yes, I have the need they're talking about, and it's compelling enough I'd work with a startup, yes, I'd work with this company, and as long as they execute as advertised, I'm planning to buy from them. Now, that's the minimum. What's happened is there are a lot of companies that come to the Tech Coast Angels now that are beyond that and have not only that, but they have a decent amount of revenue, maybe $1 million, maybe $2 million of revenue, and also have, in some cases, at a tightly controlled burn rate, cash flow break even or profitability. So we're seeing a number of companies like that now. But we'll go back as far as the beginning of that spectrum.
And so Dana, from your perspective?
So, yeah, so what we look for, and this is just, Greycroft specific. It's certainly not, not every fund. I mean, yeah, that's exactly right. No, but I think there are definitely funds that will fund things at an earlier stage than we will. But we like to see that there's a product built in market with revenue, and with revenue ideally from, well, not ideally, with revenue really from customers that represent the kinds of customers that the product is going to have over the long term. Because I think one of the mistakes that we've made, and I think probably the single biggest challenge in venture investing in general is timing. And so, there have been plenty of situations where we'll see a company and they'll say, well, we've got, we're generating revenue, and then when you sort of get into it, it's not exactly revenue from the product that we believe can scale. And so I think what we spend our time in terms of due diligencing is really understanding who the customers are, where those, the customers, if the customers that the company is working with are the customers that are going to really sort of help the product cross the chasm and really get to sort of that next tier of sort of bigger customers that will help them move into a much larger market. And so, it's, I think, really understanding who the company's customers are, whether it's consumers or enterprise, and being able to talk to them and sort of feel the product and see the momentum in the market and make sure that it's not just we spend a lot of time in the digital media space, so with advertisers and advertising agencies, making sure that it's not just like test budget, or just there's lots of people who will spend money sort of trying things, but it doesn't actually represent a model that will scale. So that's primarily what we look for in terms of what stage a company's at, and then we look at all of the other really critical factors like who the team is, and if this is a team that can again accelerate their chances at getting into the market. Do they know the customers already? Do they understand what those challenges are going to be to scale? From a product perspective, have they scaled a product like this in the past so that when you get it out there, if it really hits, that you're going to actually be able to to respond to the demand. And then, as always, just making sure that it's a market that's large enough that it can support a venture investment.
Okay, so Rick, let me ask you this. So the panel we were talking about before, you guys weren't here, but we were talking about monetizing your intellectual property. And so someone's taken a technology out of a university, or they've created a technology, they're an entrepreneur, they need money to now get a business going. They don't fit that profile. They don't have revenue. They maybe haven't even finished their product yet. I read about Crosscut, and I see Crosscut's a seed investment fund. That's perfect. That's what I need. I need a seed investment. Does that work for you?
No. Well, so
Elaborate.
I think when we started Crosscut 2 years ago, we thought we would be doing more deals that are just sort of two entrepreneurs and a napkin and an idea, or maybe a technology. But as Bill was saying, just given the dislocation in the market the last couple of years, we've been able to take what I think is a little less risk in our deals and let them sort of get some traction before we jump in. Now, most of our deals are probably still pre-revenue and pre-product, so we're still probably earlier than most. Well, we are earlier than most. But even we have the ability to kind of say today to people, I want to see a little bit more. Either show me the first potential customer we can talk to, or show me the second member of the team, or something like that. And so for the most part, I think those companies are still needing to rely on friends, families, and fools to back them at that early stage, right? And really you're getting backed on who you are and someone that has worked with you and trusts you. And it's like, I don't really know the product, I don't really know what you're doing, but I'm going to invest in you. And that's probably still the best source of that capital. When markets heat up and we feel like we may lose that option, because those people then tend to come back to us. When we feel like we may lose that because there's 10 other people bidding on the deal, then we'll have to go earlier. But right now we don't have to. And I tell people I don't invest in early stage companies because I like the risk. I'd rather invest in Cisco if I could. But we're looking for outsized returns. We're looking to way outperform any other equity instrument out there, and without leverage. And so we have to go in early and take that risk.
Greg, what are you looking for? You looking for two guys in a napkin?
I'm looking for two guys I know really well and a napkin that presents a really big idea. So we will certainly invest in those companies. I think the bar gets raised when we know the people sort of less well. But we definitely target really big markets. And if someone's coming to us with a really big idea, and we feel good about them, we feel good about how we can help and how the plan sort of hangs together, we'll take that kind of risk. But it's got to be big, and so I think that's the smaller the market sort of feels, the less risk you're going to take. And so we'll do deals where there's a path of liquidity at a smaller, let's say, amount. Maybe it's some sort of merger and acquisition, but in that case, we're going to be willing to take less risk because the reward isn't as great. So I think in a lot of cases, the amount of risk we take is based on the size of the reward. And I agree with Rick. In this environment, firstly, a lot of entrepreneurs are able to get things going for a small amount of money, and therefore, have a product, have some customer traction, so that they come to us with a little more than an idea. And secondly, I also agree that there aren't a lot of people willing to take this kind of risk, and the bigger VCs who might have historically taken the risk, there isn't the ability for them to put enough money to work in some of these really early stage situations. So it actually is a good position. That's the reason why you see the rise of the super angels up in Northern California, and firms that kind of act a little bit like Rick and my firm, and although I think we're a little more institutionalized than they are, and so it's actually a nice place to be. And we're seeing traditional venture firms kind of come down into this market, but then they tend to push entrepreneurs a little bit to take more money than they're comfortable with, which creates a new set of problems. And so I think the venture industry is going to have to change and adopt. Probably the funds, the fund sizes are going to come down, to sort of match, the new needs of the entrepreneur. And frankly, they're going to have to come down to match the anticipated outcomes of the market. Because I think what we haven't talked about, and maybe I'll save some of my commentary to the next question, is the market, the venture market is really pushed by, the IPO market, and the ability to do deals and the ability to generate outsized returns is really almost, attracts the IPO market almost one-to-one. So, we all, if that market isn't thriving, or fewer companies can access the IPO market, it changes the way that you need to look at an investment, and I think that's going to be a major disruption in BC going forward.
Yeah, we're gonna get to that if I pace myself well in just a little bit. But let me ask Kevin and Dana to both address this question, and let me make an important distinction for you. What both Rick and Greg were alluding to is that there's sort of a difference in who is coming to them with an idea and with a potential company. In addition to sort of this spectrum of how early you are in the process, it's also who you are and what you've done. So for instance, Dana and I just worked on a transaction last month that a very, very well-known entrepreneur who was on his third or fourth very successful company, came up with an idea. He developed the technology in stealth. As soon as the technology was done, literally it took us 2 weeks to fund the deal. Dana's firm funded it. Another significant venture firm funded it. There were 5 super angels in the deal, and we closed the whole thing in 2 weeks, and nobody really did any significant due diligence because of who the people were. So that's probably not this audience. This audience are, students and grads of the MBA program, and technologists who are looking at technologies coming out of various universities. So they come to you, Kevin and Dana, and they have coffee with you, and they sort of tell you where they are in their plan, and you look at some of those metrics you were talking about, Dana, about is this somebody who can scale an idea? Is this someone who's done it before? Aside from telling them, I'm really sorry, I'm not going to fund you, but you need to go talk to your uncle and your father-in-law and everybody else, what advice do you give them about building their team, moving their project, moving their idea forward?
I'll take it first, Craig. We tend to focus, as I mentioned earlier, on companies that are a little farther along. And one of the metrics we pay a lot of attention to is, trying to think through, or it's a set of metrics around the go-to-market economics or the sales physics of the company. Our firm tends to invest in more enterprise than consumer technologies just by virtue of the background of the teams, of our investing team. I would agree with the panelist's comment that you can start a company for less money, and unless you've got a product that's viral, and in reality there aren't that many truly viral products, the amount of money it takes to go market your product and scale up your company really hasn't changed that much over the last 10 years with open source. I don't think I've seen any startups really be that successful outsourcing their sales force to India, for example. So we tend to focus a lot on the team and the metrics about, what's it take to sell the product. And so if you are, someone with a technical background, for an example, and you have an idea about a better mousetrap serving a particular market, I would urge you to go find people, to help you sell and market that product that have lived and breathed in that market for some period of time. You want to make sure they understand the customer. You want to make sure they understand the customer's buying processes. You want to make sure they understand the customer's pain point. In a period of scarce capital, it's fatal to make mistakes in that go-to-market phase. We've done a bunch of empirical research on our companies that have worked, on other companies, other firms. We have access to data, their portfolio companies that have worked. And for companies that really target, say, the enterprise space, a third of the money they eventually raise, and these are the winners, is raised to develop and prove out the technology. That's the expense pool that shrunk. 2/3 of the money they raise goes to building out a sales and marketing organization. And so mistakes and failure at that point, is just too expensive today. So get a team that knows how to sell to your target customer.
Yeah, I would definitely echo the comments. I think, one of the things that we sort of look at that's, less of a tangible metric, but, in terms of looking at companies with people that we don't necessarily know are, you want entrepreneurs that are scrappy. And so looking at, kind of the way that you've managed to get out and meet other people and who you've, managed to pull in. What we're looking for when we look at, companies are who's validated it. And so if you've got a product or a product or a concept that really makes sense in the market, and you're scrappy enough to get it in front of the people that can validate that, that's both showing a great product, but also showing a really scrappy entrepreneur. I mean, that you're getting and so, I mean, we try to keep ourselves as in tune with the markets that we're in as possible, but the reality is the people that are really in tune are the people that are actually in the market. So depending upon what the product is, that's kind of the same thing that Kevin was saying is, you really have to feel sort of the pulse of the market and get that feedback firsthand. So if you can come to me and say, here's my product concept, and I validated it with like these 4 people who you've just cold call. I don't care if you cold call them. I mean, just get to them, because if you've got something that's interesting enough, those people will take those people will take your call. And so, coming to me with that is a lot more interesting than just, hey, here's my idea. Because if it's, hey, here's my idea, I'll say, well, I think that sounds like a neat idea. It's so I think it just gives that much more credibility, obviously, to both to the product and the market opportunity, but also to you as an entrepreneur. So that's kind of a specific thing. And then I'll just make a comment about it's interesting. I just came from New York last night. We had our LP meeting, our annual investor meeting with our LPs, and one piece of data that I saw is that in the last 12 months, the number of active venture funds, according to, and there's lots of data, but it was about 200, which is down from probably 1,000. 1,200. Thanks, yeah.
Active is one deal a year. I mean, it's
one a quarter was this
One deal a
definition.
quarter,
So,
okay.
but so, if you think about that in terms of institutional funding, it really has dropped dramatically. And so, our bar really is just that much higher. And at the same time that costs have come down to start things, I agree with Kevin that the cost of building a brand and a sales force and everything has not changed. But the barriers to entry into markets have also come down that much, because you can get something jump started for a low amount of capital, which is why it's so critical to just be scrappy, get in with key partners and customers, and get that feedback. Like, don't be afraid to get out, get into market, get that feedback early. I think so I'll be quiet.
But let me echo this
Yeah.
in particular. I've funded deals out of Caltech and UCLA before. I think that a big mistake a lot of people make is when they finally get the technology out is,
Yeah.
there's a technology, isn't it great? We see, to us, new ideas are a commodity. We see them every day. We get the best and brightest people in the world coming up to us every day saying, this is what the future is going to look like, this is a great new thing. So how do we sort through all that? It's who can take that great idea and make it a company, and then it goes into scrappiness and everything else. The scrappiness can't be overrated in this whole equation.
Yeah, no, I mean, that's important. I mean, I know funders feel that way. They'd almost rather back a proven entrepreneur opening a gas station than the next greatest technology out of a university that's got nobody attached to it who can make it work. So, Greg, let me follow up with you and ask you this question. Having gone through this process with you recently of moving the founder to the side and bringing in the CEO. So you funded this company that you think is great. It's got a scrappy entrepreneur. You're impressed with where they've gotten it. How clear are you with them? I mean, I think most entrepreneurs think, I'm going to found my company, I'm going to get it out into the market, and I'm going to become the CEO, and I'm going to be, the next. And as we know, that seldom happens. It happens, but it seldom happens. So how clear are you with the entrepreneurs up front that they're probably not going to be the CEO, and when do you broach that topic?
Very clear. The first thing that we want to make sure we have an agreement on what the objective of the business is. Some entrepreneurs, one of their objectives is to run the business and be in control and have it be their lifestyle. And we know right away that that's not something we want to invest in. We want to make sure that we're there to maximize the value of the company. And we want to agree that in order to maximize the value of the company, we're going to have the best people running the company that we can possibly find. And we're going to agree that, and in most cases, sometimes it happens up front, that entrepreneur might not be the right person to maximize the value of the business, and in many cases we come to that agreement up front, And if there's agreement, we often will have, an immediate CEO search. We often will have a CEO that we bring into the company, or we will agree that, if certain, objectives and milestones are laid out by the entrepreneur as to what they will accomplish. And I think, a fair way to sort of assess, someone's abilities to achieve those milestones is to let them achieve them. And obviously, to the extent to which they are being achieved, that's great. If not, then we revisit the discussion. But I think it's really important to have that conversation up front so that the entrepreneur and the venture capitalist are completely aligned in terms of how they view the business, what they're going to do under certain circumstances. So I don't think it's a good idea for, the venture capitalist to be, sort of, blowing, sunshine up the entrepreneur's ass, or vice versa, frankly. I mean, I think honesty and trust. I mean, when you work with an entrepreneur or you choose a venture capitalist, it's a little bit like a marriage. I mean, there's got to be a lot of trust. You're putting a substantial amount of your future net worth in the hands of, in the hands of the VC who's going to be your partner in growing and building this net worth. And in some senses, it's, the other way around as well. The VC is putting a lot of capital, their personal reputation, into the business. And so, that trust factor is really important. And I think you have to have it up front, and it has to be very clear. And usually when that happens, not always, I mean, there's always egos involved. There's always, discrepancies about, well, what milestones happen, what factors caused, you not to hit those milestones. There's always some debate. But I've found that works pretty well. And it often doesn't happen right away. I mean, I've had a situation where in one of my businesses, we told the founding team up front that we wanted to bring a CEO. There was a lot of hemming and hawing, and they didn't initially get along with the new CEO. And every day for a year, I was on the phone with them, sort of talking them through why I thought this person was great. 4 years later, their 20% of the company was worth $36 million, and they said, "You know what? You were right." That was a really good decision. But it's always a difficult challenge, and that's why you have to, entrepreneurs in this room, you really have to spend time with the venture capitalists, check them out. Just like we do a lot of diligence on entrepreneurs when we make investments, you got to do the reverse, because that trust factor is so key, and you need to know that if they are making that decision or bringing that person in, that you have the ultimate trust in them.
And Bill, what about TCA? They have a similar perspective on entrepreneurs?
Yeah, I think, well, first, one thing, you hear the paraphrase of, oh, those evil venture capital people, they give you money, and the next thing you know, they're bringing in their own people and you're out. Well, that's not true at all. And as an entrepreneur, you really wear a couple of important hats. One is founder-owner. You are usually the largest shareholder in the company. The other hat is employee. And when you're wearing your founder-owner hat, you should be saying, I need the absolute best person in each job to make sure this company becomes as valuable as possible. And as long as you have that mentality, it all works great, because you're not going to risk your business on your inexperience on a certain job. Now, however, you take it the other way, what do we want in entrepreneurs? Usually, the entrepreneurs have an insight or capability that's special. They know the market very deeply, or they know their technology very deeply in ways other people didn't get. That's why they're entrepreneurs, and they have an insight to start the company. The rest of the stuff, some they know, some they don't, and that's fine. The most important thing from our perspective is that insight and then the passion, which is also called scrappiness, but the passion drives the scrappiness. That passion to go the whole distance to make this happen, because it's really hard. The next super important thing is open-mindedness, and being open-minded that there's things they know and things they don't know, and they want help on things they don't know, and aren't going to say, well, geez, maybe I should know that, so I'll make decisions anyway, or I won't reach out to those folks because I'm embarrassed, or I won't admit my problems. because I'm embarrassed. We need them to have that open-mindedness and the trust to do that. So those are the key elements that we look for. And I'll tell you to another story. We had one entrepreneur who was good guy, good business, TCA. Between TCA and another fund, we had $2 million lined up for this person. And he was founder, owner, and had a new CEO picked out. 3 heart-to-hearts with the person. You know, we want to do this. This is how it's all going to work best. At the end of the 3 heart-to-hearts, he still said, no, I'm not going to bring in another CEO. And we killed the deal 24 hours before funding for $2 million. Yeah. So it's that serious.
Kevin, pieces are probably a little more in place on deals you do, but I suspect this issue doesn't go away.
Generally, and I'd also make a comment, you know, I'm 10 years in the business. I've, you know, historically done early stage and seed, as well as, you know, it's currently, we're probably doing more mid stage. But if you were to, you know, talk broadly to people within the venture industry, we tend to do a lot better. We get better outcomes on the deals when the initial CEO takes the company the whole distance. On average, that's what we all tend to look for. We want to believe that we're betting on the right horse and jockey that are going to, you know, win the Derby. If there's a silver lining of any kind, and there being less capital in the business today, you know, I think it probably forces investors and the entrepreneur to have a much clearer picture of what leadership in the company is going to look like, you know, before they sign the term sheet and fund the deal. 5 years ago, when capital was relatively abundant, investors, institutional investors, sometimes were willing to take the risk of, yeah, you know, we'll put $5 million in this company and we'll go hire somebody. That really doesn't happen today, and I think that's actually a better deal for you as founders, in that you have a lot more clarity and visibility about what the structure and what, you know, a new person's going to look like if they're coming in to lead your baby, you know, before you sign on the dotted line.
Okay, I think I have time to cover 2 more topics and leave some time open for questions. But so really quickly, those of you who want to comment on this, the point that you raised earlier, Greg, how does the IPO market, or probably more accurately, the lack thereof, affect the venture capital market?
Well, I mean, the IPO market presumably is, I mean, the venture market is largely driven by, you know, the top 5% of outcomes, and the top 5% of outcomes are largely initial public offering companies. So, you know, we are in the hits business. You know, we are in the business of trying to be in those, you know, 5% of deals. And if the IPO market is scarce, or is compressed in terms of the multiple, you know, valuation multiples that you can get, you know, that's going to affect the whole market. And if it's more difficult to access the IPO market, then the liquidity path for most companies, you know, becomes, you know, an M&A outcome. And M&A outcomes are affected by the IPO market, because if a company doesn't have sort of the threat of going public, you know, that's limited leverage for a seller to sort of maximize price, because that's just one liquidity outlet that they don't have. And also, you know, if the valuation multiples are lower, that affects your M&A valuation. You know, in the 90s and 80s, we had sort of micro cap IPOs where, you know, companies under 100 million of market cap could raise, you know, 20 or 30 million dollars. And do the, you know, scaling, you know, with either an enterprise or a consumer business that's necessary to sort of really grow a company to over 100 million of revenues, and they could do it by accessing the public market. So A, it was a great source of capital, and B, it was, you know, a potential for liquidity. These days, you know, if you're not a 350 million minimum market cap company, you really can't access the IPO market. So, you know, and the number of companies that can be worth that much is always been low. I mean, other than that rare, you know, that crazy period in the late 90s, I mean, it's very difficult to create that much market cap. And so therefore, all of a sudden, whereas you could access the IPO market at 100 million of market cap, now you need to be 350. So anyone under that threshold is now really looking for some kind of an M&A exit. And so, you know, the leverage that you have, you know, to maximize value in that market is smaller, and there's fewer companies, frankly, that can buy companies, you know, that are sort of, let's say, greater than 150 million and less than 350 million. You know, so all of those factors mean the overall outcomes in the market are less, and therefore the capital that can sort of go into the market has to be less, or else the multiple of returns is going to be less. And so, we had a crazy period, and sort of after the 99-2000 time, where we raised 125 billion of venture capital. We're moving down, down significantly from there, now. But I think that number's got to be a lot lower, so that the initial capital in sort of mirrors what the exit outcomes out are. And I think until we see the ability for companies to go public again in the under 150 million range, I think this problem is going to persist for a long time.
Anybody have any different perspective?
I would say one thing, that I think we're going to see more and more a difference between the U.S. IPO market and other IPO markets, particularly Asia and Hong Kong, because so much business is going over there. The opportunities are getting so much larger. The number 2 country for billionaires now is China, and that's accelerating. So I think in the U.S., as we know, has constrained IPOs and public companies with some straitjackets that aren't the same in other regions. We have a company that started out as a U.S. web-based company. Turns out that the opportunities in China are now dramatically bigger than in the U.S., and they've formed a Hong Kong joint venture company to capitalize on that. It's about to go really big, and there's already a big set of folks, S.G. Cowan, names that we know in the U.S., that are ready to take them out on the Hong Kong exchange at the right time. I think that's a trend, and I think the U.S. is going to start to have to watch that.
Yeah, I would just add quickly, I mean, I think one other sort of interesting trend, and we have yet to see what the real outcome will be, but is the secondary market for private companies. And it's it's, if you aren't familiar with it, there are, companies out there, second market, shares post, where companies are selling, employees and investors are actually selling secondary shares of private companies, and this is something that never existed before. And so, the interesting thing is Facebook, Zynga, Skype. I mean, you name it. There are all of these companies out there that are multi-billion-dollar private companies that have never had a formal public liquidity event, but where there have already been many millionaires created out of those companies. And so, the question is, once people sort of cash out in a private company, sort of what does that mean? I mean, do people, does the same kind of ambition exist inside the company? I think we have yet to see how that really plays out, but I do think it's an interesting current trend that doesn't seem to be going away.
Okay, quickly, and then we're going to get to questions. Just down the line, what is the best way to access you?
You.
Just drive.
Well, that's actually a good answer. Elaborate on that.
No, we work with a lot of, we see a lot of deals. I mean, I was seeing 1,000 deals a year, and I like to look at them all, to be honest. But given limits in time and the need to prioritize, I'm going to look at deals that come from sources that I trust. They tend to be other entrepreneurs, entrepreneurs in my network who've given a little bit of a filter. People like Scott, who work with startup companies and who I've worked with in the past, have a sense of kind of the things I'm looking for. When you're an entrepreneur, you have things that you need to do. You need to get office space. You need to get a lawyer. You need to probably get an accountant. And so one of the things you should ask them, in addition to the quality of the service they're going to provide, is who do you know? What are your relationships like with capital sources? Because those people really draw are the people we trust and the people that are going to get our attention and are probably going to make it a lot easier for you to access capital. So it's very important that you're working with people, if you need capital, if you need introductions to venture capitalists, that you're thinking about working with the people that have a nice network and sort of have a good name and reliability in the marketplace.
Kevin?
I think I'd build on Greg's suggestion just a little bit. Greg and Dana both earlier said go find advisors or get feedback from people who really understand your market. And I get questions all the time about what are the right advisors for me to talk to help target a particular venture firm. And I think that's the wrong way to look at it. Go find the people who know your market, know your space, engage with them so they help improve your business idea, improve your company, And they will naturally lead you, if they're entrepreneurs that have taken venture money before, to a set of firms that they've worked with before. Follow the path that way, not targeting, how can I get Greg or Rick's email, unless they're guys that you think really understand and know your space.
Rick at crosscutventures.com.
Dana?
It would be really cheesy if I said the same thing now. No.
Oh, that's not my right email.
No.
Just gets me out of here back on the road.
No, but I would echo all the comments. My best source of introductions and of companies always is other entrepreneurs and my portfolio companies, because they're in the market every day. They know what the real pain points are, what the real opportunities are. So just echo. Get into those networks.
And Bill, a little more formal?
Yeah, well, and as from an angel perspective, it's good because it's www.techcoastangels.com. And there's, some of you may have seen that website, but there's a whole format for you to fill in, and you can go ahead and do that. And every idea, every business plan is reviewed, and at a minimum, you'll probably get some feedback on that. And everything's kind of free through the services. There are some angel groups that actually charge. TCA does not. So go through, you'll see we look at everyone online. That said, if you have a way to network into the angels, that's one notch better, because the screening director will say, does anybody know this company?
Okay, questions? Yes, sir.
Good afternoon. Mark Huseman with ReduceIt.com and 1-800-REDUCE-IT. I guess this is more of a question for Rick or Greg, but we've gone through our friends and family round. It's now time for our seed round to take it to the market. In that $500,000 to $2 million space, what are you looking for in a return at this seed level, long term? And then what else do you bring to the table as far as how else can you help us grow? Do you help structure us and position us for our A round also?
People always ask me what I look for. I think every investment I've ever made, I've known I was going to make the investment in the first 15 minutes of the presentation. So there's that kind of blood pumping quotient that one needs, and it's usually the size of the market and the quality of the entrepreneur. And by the way, a lot of the companies we invest in, the entrepreneur is unproven. They may be really young, or so it isn't necessarily track record. It's just a special quality about the entrepreneur, their passion, their energy, their intelligence about the market, and sometimes some intangible quality. So I mean, I think I just want to believe there's a really big business here, and that you and or your group can grow that business. I'd like to. I spend a lot of time in various markets, and so I understand. I like to invest in markets that I understand, and I think you should work with venture firms that also understand your market. So, and if you understand the market, you can provide value just in that understanding. The other thing that we do is, I have a network relationships. I'm sure Rick does. Hopefully the venture firm is going to be able to introduce you to partners, customers, help you recruit quality people. Hopefully they have a network of people. If you need a VP of sales or you need this or that, so your venture partner, especially at this round, should be very hands-on, not running the company, but just your partner. Very close. You need things. Obviously, in the future, if you need capital in the future, hopefully they have a network of capital providers that they can sort of help you, land, future capital with, help you recruit people. As I said, the partners, the customers, and the other thing that you should like is someone who knows the competitive landscape, kind of knows what's going on, so you're not blindsided by things, so that kind of they're your eyes and the ears as well. And I think if you don't have those things, then they're just money. And not that you can get just money anywhere, but given a choice, you should certainly choose someone who's going to add value. And that goes to the valuation discussion too, because entrepreneurs shouldn't get hung up on a few points of equity one way or the other, because all of these businesses, the outcome is binary. It's either zero or something pretty good. And so therefore, all you should care about is maximizing the likelihood that you'll have the good outcome. And so therefore, a few points of equity, one way or the other, whether it's, whether it's bringing in the right person or whether it's a VC firm that maybe the price is a little bit lower. If you think that that guy or that venture firm is going to, increase the the likelihood of success, you should just forget about points of equity. I mean, I know that's maybe self-serving, but you absolutely have to think about it in those terms.
I think you asked what expected return. The people on this panel are really smart, and I think we're really good at what we do. We're still wrong 8 or 9 out of 10 times. So the one that's right has got to be a 10 or 20x. So we're looking for, it's got to be a big return, whether it's a huge outcome or a low valuation with a medium outcome, but we need to see that we can make a lot of money on any one deal because we're going to lose a lot on the others.
Yes, sir. I had 2 questions. The first one is when you recommend bringing in your own chosen CEO, what is the sort of a ballpark range of compensation that CEO would get in terms of percentage of equity, basically, and would that get diluted over time? And then the other question is maybe more for Kevin. Do you ever get involved in situations where that are more like a turnaround situation, as opposed to, say, you have an entrepreneur that sees an existing business and sees that it might take $5 or $10 million to acquire that, it's for sale, and it's in trouble. Do you ever, would venture capital firm get involved in something like that, given that, say, the entrepreneur did know the industry and did have a plan? Is that something you ever look at?
Well, I'll answer the second question first. Venture capitalists get involved in turnarounds all the time, but not really in that way. It's usually in one of your existing portfolio companies that gets 2 wheels in a ditch and a little bit of bloom comes off the rose. And in bigger partnerships, it's not uncommon for the older partner that initially made the investment to hand it off to the junior partner and ask if you can somehow make something of the company. The turnarounds, assuming it's a technology business or not, private equity and growth investors, are probably a little more likely than venture capitalists to invest in that kind of a situation. What would be an exception there is a business that had just phenomenal growth potential. I thought Greg articulated things pretty well. We look for outsized returns for big hits, and what normally drives those great exit metrics are phenomenal growth in the big market. So, and in terms of your question about CEO compensation, in part the answer depends on the stage of the company. Most of us have access to surveys of venture-back or seed-back company compensation for CEOs. We typically, if we're a board member, try and set compensation that's competitive in the market. You need to put something out that's really going to recruit leadership that you think is absolutely top quality leadership to go the distance. But it really varies depending on where the company is, what type of business, what stage it's at. And in most cases, we do expect that equity is going to dilute down a bit over time. We try and avoid situations where a management team has their hand out to be re-upped, if you will, after each successive financing. We want to have our interests aligned. We as investors are going to take dilution on the money we put in a prior round, and the more aligned we are, the more harmonious the relationship typically.
But would you agree that as a general rule of thumb, if it's a sort of a funded business going to market that's ready to scale, a CEO is going to be in the 5 to 6% of equity range at the low end to 10% if they're a rock star, and then they're going to dilute after that?
That's ballpark.
Yeah, and one thing too, you said your own CEO, and you may not have meant that, but that's a very important point. It's a team, and it's a team decision, and if there's no chemistry with the founders as well, it's a non-starter. So it's founder, owner, working with other owners to come together for what are the best employees. I just want to overemphasize that because it's so critical that it's a team effort.
Yeah, back there.
You've all talked about the various benchmarks that you have for evaluating companies. Should we as entrepreneurs only approach you when we are very confident that we meet those benchmarks, or should we reach out in advance and try to start the dialogue before that point?
I would just say, I mean, having spent a year fundraising for our second fund, which is a long time, you know, I think the more efficient that you can be with your time, the better. So, you know, maybe reaching out and just making sure that you understand the benchmarks and the metrics that we would specifically look for, and then coming back once you've achieved those, I think makes sense. You know, I think, you know, we'll all take meetings and things, you know, if we think that there's something interesting there. But, you know, if you know we're not going to fund, I mean, don't waste your time either. So I think, you know, as any entrepreneur or anybody, I mean, your time is the most important thing that you have. It's the most, you know, it's the most scarce resource. So being efficient, I think, is really critical.
Yeah, I'm sure you can access them later, but I think we'll take one more question. Yes, sir.
I wanted to ask you about the Facebook situation, and I was watching the interviews. There was some, one of the speakers, one of the questions was alluded to the fact that Mark Zuckerberg could actually be removed as the head or CEO of the company because there could be a better CEO. What do you think of a situation where it's a successful company with a young guy,
I think he's doing a pretty good job.
Yeah.
Well, in that specific, well, and in that specific situation, he can't be removed because he has a super super voting right, actually. So, but
you know, in general, right? I mean, I think a lot of the skill sets that we like and back and invest in with an entrepreneur who's able to go from 0 to 30 miles an hour is a different skill set from an entrepreneur who's able to manage a bunch of managers, right? I mean, it's just, there's a few examples of people who have done that well, but there's 99% examples of, you know, where change occurred. So it's really a question for us is when that change occurs, I think. And there are going to be examples, there's going to be counterexamples of that. Facebook may be one, but maybe he stays there for the next 10 or 20 years. I don't know. But
I think if you look at Facebook and Google as another example, you know, they brought in really quality, you know, in Facebook's example, a really quality COO who's really managing the business. I mean, Mark is really still, Mark is more the visionary, the product person. Just like, you know, Sergey and Larry at Google, they brought in Eric Schmidt. I mean, so, you know, I think that's how they've sort of managed that issue. You know, frankly, if you're a venture capitalist, one of the things you're really worried about is that your founder owner is going to sell too early, because Mark Zuckerberg, they could have sold that company for $1 billion had he wanted to. And one thing we don't do is force our entrepreneurs to, I mean, I think a good venture firm shouldn't force their entrepreneurs to keep going because, you know, they're not indentured, you know, servitude. It's not indentured servitude. I think in that case, Mark had, you know, huge ambitions, and, you know, obviously every venture firm that invested in that in Facebook is extremely happy that Mark didn't want to sell at $1 billion, just like, you know, the investors in Google are happy that Sergey and Larry didn't want to sell for $500 million when it was offered to them. You know, so that's an example of, we want you to keep going, but I think what they do is they build around them. They find really quality people to be COO or president, or, you know, in Google's case, sort of co-CEO to handle some of the scaling issues.
So I think all of the panel, or most of them, are going to stick around and for the fast pitch competition, so you'll be able to come access them and say hi to them and get their business cards and all that. But I'm going to turn the program back over to Mr. Howe. Very good.